Hi friends, welcome back to the channel. My name is Sanji. Did you know that you can invest in hundreds, if not thousands of companies on the European Stock Exchange by just buying one Australian ETF? Yes, that's true. In this video, I'm going to run through 3 ETFs that you can invest in on the Australian Stock Exchange right now and get exposure to hundreds, if not thousands of companies based in Europe, or even specifically in, say, the United Kingdom. This is a great way of diversifying your shareholdings away from just being based in Australia, because the whole idea of ETFs is you can get diversified and you can get broad exposure to multiple economies and countries out there. And by buying ETFs that are focused in Europe, you can get exposure to all these different companies that you wouldn't normally be able to get exposure to by just buying shares on the Australian Stock Exchange. So let's get into it. As always and ever, every time I say it, and I need to come up with a more creative way of saying this, but this is not financial advice. Do your own research. There is no undo on the stock exchange. Don't screw up. All right, let's go. Now, I found the ETFs by going through CommSec's ETF Screener. Now, you don't have to use CommSec Screener. There's plenty of other screeners out there. But the process is you go to the Research and Trading tab, you click on ETF Screener, and then from there it lets you filter on all the different types of properties you might be interested in. So you click Europe, and then it gives you a bit of a list of all the ETFs you can invest in. So the first share we'll look at is iShares Europe. The ASX code is IEU. Let's look at the breakdown on screen here. Its market cap is 554 million. It's actually the biggest of all the ones we're looking at with a European focus. Fees 0.6%, index it's tracking the S&P Europe 350, which means it's got about 350 companies it's tracking. Meant to be like the top 350 companies based in Europe. Top 5 holdings, Nestle, Roche, Novartis, ASML, AstraZeneca, which I think is one of the companies doing the COVID vaccine. That's pretty exciting. Top 5 countries it's investing in, UK, France, Switzerland, Germany, Netherlands. Pretty straightforward stuff there. Now looking at iShares by itself is not great. Let's have a look at it with another competitor, which is Vanguard FTSE Europe. VEQ was the code from Vanguard, 196 million, 0.35% fees. Now hang on a second, if they're both tracking Europe, why does one of them have a 0.6% fee and another one has a 0.35% fee? What's going on here? Let's have a look. The index, FTSE Developed European All Cap. What does that mean? I don't know, but no, I'm joking. I mean, I really don't know specifically other than what's in the index. If you want to know what all these little index things means, it's important to actually go and research and have a look at what the underlying index it's tracking and what are the rules. Whenever I see FTSE Developed European All Cap, Developed European gets me thinking they're probably not investing in certain European countries, but worth looking at the documentation. I'll leave a link below, but I'll just call out, it's really important that you get into the habit of checking what the index is, because then you'll know what you're actually investing in. Now let's look a little bit deeper. Total companies, 1,309 companies. What's going on here? This is very interesting. So Vanguard's FTSE Europe has a 0.35% fee, but it invests in 1,300 companies, whereas iShares Europe only has 378 companies in it, or about 350, and it has a 0.6% fee. What's going on there? This is the kind of thinking you got to be doing when you're looking at ETFs. Again, the top 5 companies, pretty much the same. Nestle, Roche, Novartis, ASML, AstraZeneca. Actually, it's exactly the same. Countries, it's pretty much the same, just in a different order. Interesting. 2 ETFs that do pretty much the same thing, but different fees. One is actually half the fee of the other. What's that going to mean in 1 year? Probably not a lot. But if you hold these ETFs for over 10 years, that could be really quite impactful. Let's have a look at the next ETF. BetaShares FTSE 100, F100 is the code that you'd be putting into the ASX, or CommSec, or NabTrade, or whatever. Market cap, $211 million. So it's about the same size as Vanguard's FTSE product. 0.38% fee, so lower than iShares Europe, a little bit higher than FTSE Europe. The index that it's actually tracking is the FTSE 100. And when you dive deeper into it, what that essentially means is it's focused on just the United Kingdom. So just the top 100 companies in the UK. And you can see that by the companies you see there: Unilever, AstraZeneca, HSBC, GSK, Diageo. What you've got on screen are 2 ETFs that will give you broad exposure to Europe, and another ETF which will give you very narrowed exposure to England, which is technically within Europe. Is it within Europe? Oh no, I don't know. Oh, Eurozone. That could be why they invented a whole ETF just for England, because they're like, this is not in Europe. Now, if you've watched this far, I'm just going to give you a bit of bonus content here where we're going to break down IEU and VEQ, because it's interesting. You've got 2 ETFs that are both European focused, and yet they've got completely different fee structures. I think it's worth diving a bit deeper into. So these are some of the metrics you can look at. Again, iShares VEQ going down the side, total companies, dividend payments, iShares is twice a year, Vanguard is 4 times a year. PE ratio, PB ratio, dividend yield, all things you can Google in your own time. I'm not going to waste your time telling you about them, but they're all kind of broadly the same. I think the dividend yield for Vanguard's FTSE is actually 3 times higher. I say broadly the same, then the damn thing is 3 times higher. This, I think, comes down to the fact that it has more companies within it. Because it has more companies within it, there's more turnover, which could result in higher capital gains transactions occurring. Now, this is important to understand because dividend yield when it comes to ETFs is composed of both the dividends that actually get paid out by the companies in the index, but also if different companies get added or taken away from the ETF, the capital gains that the ETF may have made will get translated into dividend payments to you. So that's potentially what's going on there. Now, when you look at the last line, the cross coverage, this is where I actually unpacked both ETFs and I said, what are the holdings in one and what are the holdings in the other? And I noticed 98% of the shares in IEU are also in VEQ. So you buy VEQ, you're buying pretty much IEU plus some other shares at a lower fee. I'm going to let that sink in. I might even repeat it. No, I can't repeat it. It's YouTube. You can rewind it. Let me put that another way. If you buy shares in VEQ, you're essentially buying IEU as well, but for a lower fee. Plus you get a few other companies as well. From a broad diversification point of view, VEQ is the smarter play. You get more companies, broader reach. If you really want specific performance, maybe IEU is the one to go with. Now I know what some of you are thinking. You're sitting there saying, Sanjay, you're a bit of an idiot. The reason iShares picked the top 350 companies versus over 1,300 companies is because they wanted to get a concentrated performance view and they wanted to get like the niche, the cream of the crop, the best companies in Europe, and they thought that would outperform the broad-based ETF that Vanguard is using. If only I had looked at the performance of the ETF side by side. Of course I've looked at the performance of the ETF side by side. What kind of tin pot YouTube channel do you think I'm running here? Let's have a look. Here we go. 2 ETFs, performance over the last 5 years. I pulled up using Yahoo Finance. In blue, you have IEU, the iShares product. In red, you have VEQ, the Vanguard product. Over 5 years, there's not been much going on. 16% for VEQ against IEU's 14%. And you can see the trend is like it's broadly always within a couple of percent of each other. Now, some of you who are really deep into this stuff are going to be like, Sanjay, again, you're an idiot. You got to look at the total share return, okay, total shareholder return. You can look at both dividends and capital gains. Well, in that case, you got me. I actually didn't bother doing it. I know it's something I should look at, but I didn't bother. And what that's saying essentially, guys, is on this graph, what you're seeing is the movement of the ETF from a capital gains point of view. So you buy $1,000 down there and it's gone up to being worth this much. In the process of holding these ETFs, you can see the little D's in the graph. You would have been paid dividend payments. And realistically, you need to combine both your capital gains with your dividend payments to get your total shareholder return. So if I was looking to increase my exposure to Europe through ETFs and I had to pick between IEU and VEQ and the F100, I'm a naturally quite a conservative investor, I guess you could say. So I always go for the broader based index. So I'd lean towards VEQ. That's not financial advice, but that's just what I would do. I always go for the broader ETF with the lower fee because I don't see the need in necessarily narrowing in on it. That being said, people have pointed out other ETFs out there like NDQ, which I think is quite a narrow ETF, which has performed quite well. So there is a case for narrow ETFs as well. But in this case, if you're going for a broad geographic region, just go for the broader one is what I would say. I would probably avoid something like F100 because it's too specific to one country. As always, let me just say, if you're interested in investing in ETFs, it's worth taking the time to understand what each of these do and also breaking down the key details around what the actual indexes they're tracking and is there any overlap. Like you saw there between VEQ and IEU, you get quite a lot of overlap. So why would you bother getting the more expensive one with narrower focus unless you really thought it was overperforming, which it's not really. So, what's going on there? Anyway, if you're interested in a video similar to this, but with the focus on investing in Asia, check out my video here. I did one recently there. If you're interested in renewable energy, you should check out some of my videos on renewable energy, both specific companies you can invest in Australia and ETFs that you can use to invest in renewable energy in Australia. And I mean, I'll probably put up another video here, which is probably the one that YouTube will recommend too. Anyway, I'll see you in the next video. Bye for now.